Greetings from 3Edge Asset Management. My name is Fritz Folts, and I'm the Chief Investment Strategist here at 3Edge. And I'm pleased to be joined here today by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Today is Friday, June 5th, and as Steve and I have done throughout the COVID-19 crisis, we'll be providing a brief recap looking at this week in the markets, and we'll also look at a particular topic that we believe could help investors better understand the current environment. As a reminder, all of our videos are available on our YouTube channel, and please also feel free to share these videos with anyone who you think might be interested. So let's get started, and I want to bring Steve into the conversation right away. So Steve, we're entering into the summer months, so I thought we could talk in terms of waves, and investors certainly seem to be continuing to ride a wave of enthusiasm for a V-shaped economic recovery, meaning a steep incline out of the current economic downturn. In fact, as you and I discussed earlier this week, we've now seen the Citigroup Panic Euphoria chart, which is a great chart. We see the Citigroup Panic Euphoria chart, it's back into the euphoria state, which may seem a bit odd since we're here in the US, we're experiencing a fairly widespread social unrest, and the world continues to struggle with the COVID-19 global pandemic. So what are the scenarios that markets are counting on to continue to move higher from here? Is it all about monetary and fiscal stimulus, or is there more to it than that?
Well, the monetary stimulus has been like rocket fuel. And something happened important this week, Fritz. The rest of the world has jumped on the same bandwagon. So now, in addition to the Federal Reserve Board expanding its balance sheet and adding literally trillions into the system, we have the Bank of Japan expanding its monetary stimulus into the trillions. And now we just heard from the European Central Bank, the ECB, that now has gone into the trillions as well. So this is a global phenomenon. Second, we had a report this morning that the unemployment rate was roughly 13%. Now, if a year ago, you told me that a year from now, in the middle of 2020, we'd have an unemployment rate of 13%, I would have been horrified. That would sound terrible. But because it was expected to be even worse, the market is cheering. And then finally, the market is acting as though the coronavirus is over.
So, okay. And I do understand that, the markets are forward-looking and they're looking past it. But maybe we should talk about some of the risks to these more positive scenarios, which could include a second wave, right, of the coronavirus, forcing another round of lockdowns, or a lack of progress on a vaccine. Or what if there just simply isn't an economic recovery at the end of the current monetary and fiscal stimulus program? And one thing that I do think is interesting about the correction or the economic slowdown that we had is this recession is aimed squarely right at the service economy. I think maybe more than it has ever before. Mm-hmm. So with all of these different potential negative scenarios, what is it that could get in the way of this market rally?
I could think of a few risks, Fritz, that are really different in nature. So one has to do with the fact that more than ever before, a greater percentage of the trading that happens every day on the stock market is by machines driven by algorithms. And these algorithms, while quite sophisticated, when you get into the details, they're really basically momentum or trend following. And what that means is that when the market's going up, they can exaggerate the up moves. When the market's going down, they can exaggerate the down moves. The last 50 days, we've seen the sharpest rally ever in the history of the U.S. stock market, and that didn't even include today. So a lot of that exaggeration, you can say, is due to this momentum trading, and that can cut both ways. So that's one risk. Another risk, the market is very excited about the rebound, about the opening up of the economy, the economic recovery. But if the economic recovery doesn't go sufficiently far enough so that profits come back to where they were before this all started, then valuations will seem particularly stretched. Third, we have had this rocket fuel from the Fed, this tremendous monetary support. We've had great fiscal support from the government, and that has fueled a lot of this gain. Well, what happens if that goes on pause? If the Fed says, look, maybe we've done too much, maybe we reacted too strongly. Let's see how this all plays out. And they take the foot off the gas pedal and maybe tap the brake a bit. Or what happens if the government decides doesn't need to urgently pass another program? Well, something we've learned by reading a paper that was published by the Federal Reserve Board, linking directly the monetary stimulus by expanding the balance sheet to its impact on the markets. It talks about how, while there's a direct link, there's also a decay factor. And once you stop the stimulus, it wears off. And especially since the Fed has been buying Treasury bills. Treasury bills don't last more than 3 months and then they fall out. So that could be a third. And then the fourth, of course, something no one wants to talk about, something people hope they never have to worry about, would be a second pandemic wave. And the reality is that in our country, the curves are looking very good. The fall off of the coronavirus is really quite steep through most of the country. However, in the Southern Hemisphere, we see continued growth in the pandemic. And there's a fear, a legitimate fear, that in the fall or early winter, before we can even get the best case scenario on a vaccine, it could come back just like the flu comes back in the fall or winter. And that could make consumers cautious again.
Absolutely. Yeah, I've heard people talk about that in terms of migration, where the virus actually migrates to the southern hemisphere and then comes back as the seasons change. We have time for one more thing I would like to discuss because I think it's kind of interesting, and that is about currencies and in particular about the US dollar. And we talked about that a little bit last week, but as we know, when the markets really started that severe correction in the middle of February through almost the end of March, the dollar was such a sought after asset class and everybody went to the safe haven status of the dollar. Now we're looking at the third week in a row, I believe, where the dollar is actually declining, at least against, the basket that they typically measure, which would be the euro and other currencies. So is there something going on there with the dollar that is indicating something we need to pay more attention to, or is it just sort of because it's related to other things that are happening, and so it's unto itself, it's not that important? How do you think about that?
I think you're onto something, Fritz. So before the coronavirus hit, we had a strong dollar relative to other currencies. And a lot of that was due to the fact that compared to Europe and Asia, our interest rates, even though they were very low, were considered high because they were higher than the other countries. And so that attracted capital into financial assets to earn higher rate. Then when the coronavirus hit, there was a safe haven demand for dollars. It was considered a safe place to be. And because the rest of the world often borrows in dollars, there was a dollar shortage, and that lasted until the Fed opened up the swap lines. Now, after the Fed lowered rates, we have rates much closer with the rest of the world. So we don't have that advantage for the dollar anymore. And now that there's a risk on trade and people are less concerned about finding safe havens, that also takes away some of the demand. So the dollar has been falling. Now, what to keep in mind is, if this isn't just a temporary blip, but if this is the beginning of a longer term extended decline in the value of the dollar, then this could eventually lead to inflation. And that would cause a different set of problems down the road.
So that's more down the road, as you say. But so great. Well, thank you for all those insights. Very, very helpful. That will do it for us. Steve and I will be back next weekend with another edition of our 3Edge Weekend Update. And once again, all our videos are available on our YouTube channel. Please feel free to share the videos with anyone who you think might be interested. And so on behalf of Steve and everyone at 3Edge Asset Management, we urge everyone to do everything possible to remain safe, stay strong, and keep the faith. Thanks for listening. And Steve, thanks again for your time.
Thank you.